Your mortgage payment may look normal today, but your renewal letter could change everything. Many Canadians who locked in low mortgage rates a few years ago are now renewing into a very different world. And when that happens, the monthly payment can jump fast. This is called mortgage renewal shock. It does not mean everyone is doomed. But it does mean homeowners need to understand what is happening before the renewal date arrives. Today, we are talking about mortgage renewal shock in Canada. We'll explain why mortgage payments are jumping, how interest rates affect renewals, why a lower Bank of Canada rate does not always mean your mortgage becomes cheap again, and what questions beginners should ask before renewal. Educational only. Not financial advice. First, let's understand mortgage renewal. In Canada, your mortgage usually has two timelines. One is the amortization, which could be 25 or 30 years. That is the full time it may take to pay off the mortgage. The second is the mortgage term, which is often around 5 years, but it can be shorter or longer. At the end of the term, you do not usually finish paying the whole mortgage. Instead, you renew the remaining balance at a new interest rate. Many Canadians got mortgages or renewed mortgages when rates were extremely low. Some people had rates around 1.5%, 2%, or 2.5%. But when those terms end, they may be renewing at rates that are much higher than what they had before. So even if the mortgage balance is lower than before, the interest rate can be much higher. That is why the monthly payment can jump. If the interest rate goes up a lot, the payment can rise even if your balance has gone down. This is the part many people miss. They think, I have been paying my mortgage for 5 years, so my payment should go down. But if the new rate is much higher, the payment may still go up. The Bank of Canada estimated that about 60% of all outstanding mortgages in Canada are expected to renew in 2025 or 2026. That is a huge number of households facing new mortgage math. Not everyone will see the same increase, but many people renewing from lower rates may feel a real budget squeeze. Imagine someone has a $500,000 mortgage balance remaining. If their old rate was around 2%, their payment may have felt manageable compared with today. But if they renew at around 4.5%, the monthly cost can be much higher. The exact amount depends on amortization, lender, payment frequency, and mortgage type, but the point is simple: when the rate doubles, the payment can feel very different. That is not a small change. If someone was already stretched by rent, groceries, car payments, childcare, or debt, an extra mortgage increase can hit hard. During the low-rate period, borrowing was cheaper. Lower interest rates made mortgages feel more affordable, at least monthly. But then inflation rose, and central banks increased interest rates to cool demand and bring inflation down. Mortgage rates moved higher. So now, people who locked in during the low-rate years are renewing after the rate environment changed. A fixed-rate mortgage locks your rate for the term, so your payment may not change during the term. But at renewal, you face the current market rate. A variable-rate mortgage can change during the term as rates move. Some variable mortgages have payments that change, while others have fixed payments but changing interest portions. Either way, rates matter. People may hear, rates are coming down, and think the mortgage problem is solved. But not always. If someone had a mortgage at 1.8% and renews at 4%, that is still a big increase, even if rates are lower than the peak. So the comparison is not only today versus last year. The comparison is your old mortgage rate versus your new renewal rate. It affects the whole budget. If your mortgage payment rises by $300, $500, $800, or more per month, that money has to come from somewhere. Maybe less goes to saving. Maybe less goes to investing. Maybe fewer restaurant meals. Maybe fewer subscriptions. Maybe debt repayment becomes harder. A mortgage renewal can quietly force a full budget reset. That is important context. This is not automatically a financial disaster for every homeowner. But stress-tested does not mean stress-free. A household can technically afford the payment and still feel squeezed every month. A household with high income, emergency savings, and low other debt may handle renewal better. A household with high credit card debt, car loans, childcare costs, or variable income may feel more pressure. Also, people who bought near the top of their budget during low-rate years may have less room to absorb higher payments. That might be convenient, but it may not always be the best rate or structure. Renewal is a moment to compare options, ask questions, and understand your choices. Even a small rate difference can matter when the mortgage balance is large. Is it fixed or variable? What is the new payment? What amortization is being used? Are there prepayment options? What fees apply if I switch lenders? Do I need to requalify? How does this payment fit my monthly budget? These questions can help you avoid being surprised at the last minute. Many Canadians wonder whether they should choose fixed or variable at renewal. There is no one perfect answer. A fixed rate may give more payment certainty. A variable rate may benefit if rates fall, but it can also create uncertainty if rates rise or stay higher than expected. The right choice depends on your risk comfort, cash flow, timeline, and how much payment uncertainty your household can handle. This can create breathing room, but it can also mean paying more interest over time. Lower monthly payment does not always mean lower total cost. That is why it is important to understand both numbers, your payment today and the total interest over the life of the mortgage. Some mortgages let you make extra payments or increase regular payments without penalty, up to certain limits. If you have extra cash flow, prepayments can reduce the principal and lower interest over time. But this only makes sense after considering emergency savings, high interest debt, and your overall financial situation. Why? Because landlords may face higher mortgage costs. Some may try to raise rent where allowed. Housing costs can affect inflation, spending, and the broader economy. Also, if you hope to buy a home someday, understanding mortgage renewal helps you understand the real cost of home ownership beyond just the purchase price. Start looking at options several months before renewal. Estimate your new payment before the offer arrives. Compare fixed and variable options. Ask about prepayment privileges. Review your budget with the new payment. Pay down high-interest debt where possible. Build or protect your emergency fund. And avoid making major new debt decisions right before renewal. Do not ignore your renewal date. Do not assume your payment will stay the same. Do not accept a confusing offer without understanding it. Do not focus only on the lowest payment while ignoring total interest. Do not panic based on social media headlines. And do not make a decision just because someone online said fixed is always better or variable is always better. It is one of the biggest financial decisions most Canadians ever make. When rates change, your mortgage can affect your budget, savings, investing, debt repayment, and lifestyle. You do not need to become a mortgage expert, but you should understand the basics before renewal day. The earlier you prepare, the less scary the renewal letter becomes. Know your renewal date. Know your current rate. Estimate your new payment. Compare your options. Ask questions. And build your budget before the payment changes. Thanks for watching Investing with Pankaj. Follow or subscribe for simple personal finance and investing lessons for Canadian beginners. Educational only. Not financial advice. Do your own research.